So, now I'm here to bring Chad Brown up. Everybody loves to hear about tax saving tips. I met Chad a long time ago in the JCs. I did not know how incredible of an accountant he was until our company doing self-storage hired him, and he saved us all tons of money. And then on my personal taxes, I right away saved a bunch of money. I was like, man, I should have done this 10 years ago. So I apologize, Chad. But there's a lot you need to know as a small business owner, as a real estate agent. So he's going to tell us a lot and give us a little bit of Q&A. So if you have questions, write them down. There'll be time to ask whatever you want. So give it up for Chad Brown.
Thank y'all. Excited to be here. It's been a while since I've been part of this group, and so the turnout is amazing. So I appreciate it. It's tax talk, so I'll try not to make it too boring and try not to put anybody to sleep. This is the perfect audience to talk to about taxes because without a doubt, the two biggest places you can move the needle from a tax saving standpoint is owning rental real estate or being a business owner or a 1099 commission. And so all of you in here, if you want to move the needle on your taxes, you're in the right place. Y'all are already interested, already doing the things where you can have the most impact. And I like to start out these things to tell you why. So here's why that's the case. So our entire country and economy is based on transactions of small business owners and real estate. Congress likes to incentivize that behavior to keep our economy going and to keep things operating at a level that we need it to function. And so they use the tax code to incentivize owning real estate and having a small business. Now let's take that a little step further. The IRS has no ability to write tax code. All they can do is enforce tax law. Tax law is written by Congress, and guess what Congress is made up of? A bunch of rich business owners and real estate investors, and they don't like to pay taxes either. And so there's all these loopholes and all these things in there that strictly benefit the real estate investor and the business owner and 1099 commission person. And so tonight we're going to talk about a few of those things, and I don't see any reason why you won't leave here tonight saving $10,000, $15,000, $20,000 on your taxes. And it's pretty light lifting because you're already doing the things in the industries and the places that we can move the needle on. So let's do it. Y'all ready to dive in? All right. So I want to make this as interactive as possible. So don't wait to the end to ask questions. Throw your hand up, ask questions along the way. I'll cover anything you want to. And let's do it. No, I am not. Well, I'm here just to educate and teach. We stopped taking new customers about a year ago. We're here in Athens. I got a firm. We specialize and all we serve is business owners and real estate investors. And so y'all are my audience, but we're in a place. I got a toddler at home. I can't take on any more work right now. So, but thank you for the question. We do have a wait list. I appreciate it. So there's no better way, in my experience, in my opinion, to grow wealth and to save on taxes than real estate, and particularly rental real estate. So that's where I like to start. If you want to move the needle on your taxes, if you want to offset business income or real estate commission or your spouse's income, if you have any income on a tax return and you're paying taxes, buying any kind of rental real estate is the fastest, best way to tremendously move the needle on taxes. I've worked with some of you in here for a long time. We do it every year. I don't care if it's residential, commercial, you get the same tax benefit, whether it's owner finance, whether you pay cash, whether the bank gives you the money. If you buy something for, somebody talked about earlier, a house for $250,000, you buy a $250,000 house, you immediately get depreciation. We immediately get write-offs. If we do a cost seg study, which I'm sure y'all have heard about in podcasts and different things, Jack's the king of it. We can do a cost seg study, or you can have that done on that $250,000 house. You can probably accelerate somewhere to the tune of $80,000 or $90,000 of tax deduction in year one. So buy a $250,000 rental house, write off 90 grand on your taxes at a minimum, because you got other stuff you can write off too. You get almost all your down payment back. Do it again next year. Or buy two houses, write off 180 grand. It's called a cost seg study. Cost seg, yep. I do it on everything I buy. A lot of you, Jack does it. You talk about commercial property. If I buy $1 million commercial building, I can write off $300,000. I can buy it in December and write off $300,000 in the last month of the year on my taxes, offset all my business income, pay zero taxes. And then the beauty is it really doesn't impact me very much, because I still got $700,000 of depreciation I'm writing off every single year. This gets way technical. I'm just here to tell you, if you want to save on taxes and you want to grow wealth, there's no better way than buying rental property. Flips are fine for making money. Land is fine for developing and making money. But if you want to save on taxes and you want a guaranteed path to grow wealth, rental property is it. It doesn't have to get too complicated. For tax purposes, it doesn't matter if it's in an LLC. It doesn't matter. It doesn't have to be any sort of entity. It could be a partnership. It could be an LLC. It could be your personal name. We get the same tax benefit either way. And so it's super simple. Buy a rental property and you get to control a lot of times how much you write off and when. Or if you bought one last year and you want to write off more of it now, you can still do that. So you have tons of options. My wife and I, we buy one property a year, every single year, probably always will, because I don't like to pay taxes on my business income. I do a lot of other loopholes and things I'm going to tell you about, but the place we move the needle more than anything else is buying one piece of rental real estate a year. Some years we buy two. Some years we do some really crazy stuff like renovate a 175-year-old house and make it a hotel. I can't even describe the tax write-offs that come with something like that. It lines up with the amount of money it takes to do something like that too. So, but that, for all of you in here, if you're looking at a guaranteed way to save on taxes and build wealth, buy rental real estate and hold on to it.
Didn't know about that, then he's going to be paying that anyways. So with those renovations you did, you basically are zero in renovations, or?
So renovations are interesting. They don't really, what I'm describing here is buy something turnkey. You don't have to do any renovations to it. You don't have to do any value add or improvements. Just buy it. And what we're doing, what this law allows you to do, it says you can depreciate. Real estate's crazy in the tax world. We all know it goes up in value. Your house is going to be worth twice in 10 years what it's worth right now. It's pretty much a guarantee. Well, tax law lets you write it off. You get to write off the house as it's going up in value. So you get to win twice. Well, what this rule does is says, hey, traditionally you could write this house off in 27 and a half years. You take a little bit a year for 27 and a half years. That kind of sucks. It's okay, but it sucks. We can break it down into components. Say, this is the air condition, this is the roof, this is the flooring, this is the light fixtures. When you break it into components, you get to write a lot of it off in 1 year or in the first 5 years. Site work. You start combining different tax laws built for business and rental property and start to accelerate stuff. So without doing any improvements, without spending any, you buy a $250,000 house, get the owner financing part of it. You don't even pay nothing down. You still can write off $90,000 on your taxes. It's crazy. Yeah.
For a cost seg study, can you tap into previous taxes that you paid? Like, let's say it was 2020, you kind of tap into those taxes that you paid on that previous tax return?
No, you can't really go back and retro. It's really hard to go back and retro amend a prior return. Now, what you can do is you could take a property you bought in 2020 that you haven't done this on, do the cost seg study now, and use it for last year's taxes or use it for this year. You can go back 1 year or do it in the current year, but you can't really go back multiple years and do a cost seg study. You can. Now, that's where you start adding fuel to the fire, and this is where Jack knows this, and we've done this before. When you start demoing, that's another level of writing off. You're now demoing components you had like separated. So now you take the $250,000 house, you take the 90, you demo some stuff, that adds another 50. You put another 100 of improvements into it, that you can accelerate depreciation. So you end up with 350 in this house, and you've written off $240,000 on your taxes in the first year, 6 months. And so $240,000, if you have if you got flip income or you got business income, say you're paying 30%, let's say you made 200 grand, you're paying 30% taxes, that's $60,000 in taxes you'd be paying. You easily wipe all that out and pay zero. And so you're able to offset. For most of you in here, you are real estate professionals. You are doing some version of this. So you can take these losses against your other business income, your commission, your spouse's income, and be able to use it immediately. So you can that's where it's really cool. So all this is packaging different pieces of tax law. So what we're taking is we're breaking it out and getting shorter depreciation lives. Then we're using bonus depreciation to decide how much to take this year. And so you could say, let's say we can take $200,000 this year. We can also choose to only take $40,000 and roll the rest of next year, or take $80,000 and roll the rest of next year, or maybe roll it out 5 years or roll it out 10 years. And so taxes is all about control and having levers to pull, which you do. You're in small business or you're in real estate. That gives us levers to pull. But now how do you get the control to pull them when you want to? You had a big year, you sold a couple of properties. We need it this year. Next year, I may lose money. I may not sell anything, or I may have a lot going on, or I may be doing a lot of construction. Another tip for some of you in here is already doing it. Chris does this. I do this. I own a small construction company. If you start combining the benefits of small business, and particularly a small construction or subcontractor business, and real estate, whether you're flipping or rental or whatever, now I got a lot of control. Now my rental property can pay my construction company. My construction company can choose when to buy materials, what to write off this year, what to wait till next year. If I'm 1031ing and I need to get some money out the door before the end of my 180 days, it can hire my construction company. And so a really huge hack to have a lot more control and really control the levers is if you have rental property and you have some version of construction. It's got to be a separate entity. It needs its own name, its own LLC. But now you can work those together to control what year you want certain things to fall into and the timing of it. And that I'll get to you and say, I easily use, and Chris, I'm sure you do the same. I easily can move the needle, easy, $100,000 to $150,000 a year on my taxes, just with my small construction company and timing of how I want that thing to happen. And so you've got several things going on with companies on your side to be able to utilize. Yeah, you can control so much. And so that's another way between cost seg studies and having a small construction company that's its own little entity in LLC. I mean, I now have hundreds of thousands of dollars of control of my taxes and my income every year for taxes, for if I need to show the banks more income for financing. And so it's all about having levers to pull and control. And you always want to, for you guys and everybody in here, you got to play that game of what you're buying and what your income needs to be for financing. And that's the beauty of this strategy. Dustin knows this. Depreciation gets added back for lending purposes. And so we have income we pay taxes on, and then we have lending income. This 200 grand we just wrote off, Dustin gets to add it back. So you get the best of both worlds. We paid 0 taxes, and now you have 300 grand of lending income to borrow on. And so you can truly win both places. Yeah, so and you can speak to it better than I do. So in the tax world, we have what you call add backs between what we do and what the borrowing side does. We like one of them is mileage. You drive $30,000 a year. We write that off. It shows 20 grand as a write off. We take depreciation on a property. That's another 20 or 30 grand normally. So now on almost every return, we call them ghost deductions, or things you don't really pay for. You don't pay for mileage. You don't pay for depreciation. It just happens. Home office, we write off so much per square foot. And so on almost every client's return we do, we'll have $50,000 to $80,000 of write-offs that are ghost deductions. Well, on the tax return, you may have made 200. We're showing 120 for taxes, paying taxes on 120. You get to add those back. And so when he's looking at debt to income, he's now not looking at 120. He's looking at 200.
Yeah, if you had 80,000.
Yeah. Yep. Yeah. And so he can add back certain things that we write off on a tax return. And I say, Dustin, because you got to have a broker that knows what the heck they're doing. Not everybody understands business owners or rental real estate owners. They don't. I see a ton of lenders that don't understand add backs. So if you got somebody that knows what they're doing, they're the difference in being able to borrow enough to buy something or not based on your tax return. That's exactly right. Yep. Yep. Oh, so this is where it gets even more fun. So I have partners in almost everything I do. When we do cost seg studies, almost everything we do. Most of the time when you buy something with a partner, it's in a partnership entity. It's an LLC partnership. The beauty of partnerships is you get to control profit and loss per partner, and it does not have to match ownership. So a lot of you know Rain and I own some stuff together. Rain and I are 50-50 partners. Say we write a bunch of stuff off. I need more deductions than he does this year. I can take 100% of the write-offs or 100% of the cost seg. The next year, we could have it go his way. We could split it 50-50. And so with partnerships, you can control which partner gets what. You get to decide everything of how much each partner gets on their tax return, and you can do it after the fact based on what you need. And so it's awesome. So you may need deductions, but your partner doesn't. You could choose to take all these and kind of square him up on the back end, or you could choose to just take your part and let him save his part, or he could keep doing traditional depreciation and not do the cost seg on his side. So you get, with a partnership, it's awesome. You get complete control, which kind of brings me to the next thing I want to talk about. In real estate, LLCs in rental real estate or property, if we're talking like boots on the ground real estate, owning something, LLCs do nothing for taxes. You don't need an LLC. You don't need an S corp. You don't need a partnership. You get built-in tax benefit for owning real estate, and especially rental real estate. You don't have to do anything. Now, most people do have an LLC because of the liability protection. Somebody falls down the stairs and breaks their neck in a rental, you need some liability protection. You want the LLC to be a veil in between you and that property. If you have a partner, having an LLC with a partnership makes sense for filing purposes and having its own bank account and having multiple people. If you have a bunch of investors, you're going to want some formal structure. But for taxes, you get the same tax benefit and you win. It doesn't matter. Now, business side, if you're an agent, if you make commission, if you do wholesaling, if you do things where you get paid a commission or you make money, you may own a landscape company, that needs to be an LLC S corp. Businesses do not get built-in tax benefit. You pay more. And so if any of you in here have a business or you're a real estate agent getting paid without an LLC and an S corp, you are paying 15.3% more in taxes than you should. You're paying federal taxes, state taxes, and what's called self-employment tax. Self-employment tax is 15.3%. Ethan knows this. If Ethan were to make 200 grand in commission selling houses last year, if he didn't have an LLC S corp, he would pay 30% Fed, probably 5% Georgia, and 15% self-employment. You're paying taxes at 40% of profit. If you do an LLC S corp, you like a switch save 15% in taxes just like that. So anybody in here that has a business or gets paid on a 1099 or a commission-based 1099, you need an LLC S corp. And so that's where we start combining business tax law and rental real estate and real estate deductions, and you easily save a ton of money. Now,
Correct me if I'm wrong.
yeah,
That's not a deduction savings. It's just paying less.
it's just paying less taxes. And it's kind of a deduction savings too, because we have something now called QBI. Trump put this in place last time he was in office. When you're an S corp and profit flows from your S corp to your personal return, it gets written down by 20%. It's just a made up Trump tax law. So if you made 100 grand in your business, when it flows to your personal to get taxed, it only flows over here as 80. 20% disappears in the process just from this made up tax law. Yeah, and so you end up saving even more taxes on top of saving taxes. Yeah. One of Jack's, I guess you're his mentor. He
was born fully formed.
Hayden Crabtree. If y'all don't know Hayden, y'all need to check Hayden out. Hayden started working for free for Jack when he was in college, and man, he has blossomed into so many things in real estate and stuff now. But he owns a cost seg company called Remote Cost Seg. They're awesome. They'll knock it out fast. They do a great job. We worked together on building that company for about a year, and so I helped with a lot of stuff there. But that's who I'd reach out to. Great question. All right. So are we tax deferring? Are we tax savings? All right. So let's fast forward a year, 5 years, 10 years. You get ready to sell a property. We have written off a lot of that basis. We have less on paper in it because we have written it off. Now, when we sell it, we have to make up that in capital gains. But guess what? Number one, capital gain rates are way less than our ordinary income. We've been using these write-offs to offset 30% and 37% income. Now, when we sell it, we're paying 15 or 20% capital gain. So we almost paying half the percentage back. That's even if we want to pay it, because guess what? We can 1031 exchange it, roll it into another property or a beach house or a retirement house and pay no taxes. Or we could sell it and buy another piece of real estate, cost seg that daggum thing, and offset the taxes on this one. Or you could roll it into an op zone fund, or you could roll it into a business startup, or go buy a pickup truck and a skid steer and write that. The future taxes are probably going to be half of what we have saved in the process if you did want to pay them. But if you don't want to pay them, there's a dozen options of what you can do at that time to not pay any taxes, so that it never quite comes to roost. Or if you're really in this for the long term and you're really the smart investor, there's the swap till you drop. You write it all off, hold on to it till you die. Your kids or your spouse get it, and they get step up in basis and pay no tax. They could sell it for whatever they want to and pay zero taxes. And so you start holding it for the long term. You start talking about 10, 15, 20 properties, or 10, 15, 20 million in properties. You've written off $15 million of depreciation over the next 20 years, and then your family inherits 15, 20, $30 million worth of property, and they can sell it tax-free. It's a dream. That's exactly right. You don't even have to sell it. You could rent it, and your basis goes up to depreciate it all over again. Guess what? They could cost seg it again and take it all again. Now, a few things I'll talk about here. What you got?
That S corp LLC thing you were talking about. How does that work? Would my brokerage have to pay me pay my LLC? Can they still pay me directly?
Ideally, it doesn't matter either way. So you can reclass it on a tax return, but ideally they'd pay you set up a checking account. They'd pay your LLC name, and the 1099 would come in your LLC. But even if they don't, it's fine. It still works the same. So, yeah.
Just a real quick question about that same thing, but when you tap the S corp, you're talking about saving that self-employment tax. Don't you pay extra though? Doesn't like the corporation pay so much Social Security, Medicare, like you pay double that kind of stuff? Do they kind of get you back on that, or am I thinking about that?
No, that's back in the 80s, early 90s. That was the case. Now it is strictly built for the small business owner. It says, you make 200 grand, save 15% of that. It's nothing for an S corp owner to save 20, 25 grand in self-employment tax every single year. You talk about over a 10-year period, that's $250,000 in savings. Now, there's a way to do both. There's a way to say, hey, I'm going to be self-employed for the next 20 years, and I want to draw some self-employed. I want to draw some Social Security and Medicare when I get retirement age. I don't want to count on that, but I do want to draw it. So I'm going to take in my S corp a $25,000 payroll salary. I'm going to pay the 15% in that. All my other money I'm going to take clear of that is just profit distribution. And then now I get the best of both worlds. I pay way less taxes, but when I get 67, I can draw pretty much full Social Security and Medicare. Not as payroll. You just take it as profit, the profit distribution. That's right. Yeah, the key is to get away from payroll or get away from self-employment tax or payroll taxes. Man, we've used that thing on everything you could imagine. We've used it on residential, commercial, self-storage, gyms, swimming pool. I mean, good God, you name it, we've done it. Mountain cabins, trailers. I mean, we've used cost seg studies on so many different creative things. It's insane.
Residential depreciate the same amount of time?
They don't. Commercial's even longer. It's 39 years. And so I buy $1 million property. I'm not excited about writing off over 39 years, but I'm real excited about writing off 30, 40% of it right now. And so it makes a big difference.
Back when you were talking about taking your losses on investment income and taking those losses on ordinary income,
Uh-huh.
do you have to qualify as a real estate professional to do that?
If you're over, I think it's right now about 100 and God, I think it's about 180 grand of income. And so if you're over about 180 to take those losses, you have to check, you or your spouse has to check a box as a real estate professional, which it's a pretty generous net. It means you have to work at least 750 hours a year in real estate and do that more than you do anything else. Contractors fall under that, inspectors, agents. I mean, it count, listening to podcasts count, reading books, coming to this meeting counts. This is 2 hours of real estate professional work. And so it's pretty easy to check the box. And just to be honest, in 25 years of doing this, I've never seen the IRS ask.
Really?
Yeah.
So if you're under 180, then you can take it without being a professional.
You can, yep.
Because I've got mixed. I've got different.
Yeah, and it depends on whether you're filing married or single. That amount changes, and there's a $25,000 loss limitation first, and then it goes to unlimited. And so the thing that you're getting different information on, this gets real technical. There's also active and passive rules, which is a 100-hour rule. And so you got this weird 100-hour a year rule and 750-hour a year rule. Now, if somebody on your tax return is not checking either box, yeah, it don't matter your income. You're probably not getting to take very much of it. So, but certainly you spend 100 hours a year. And so it again, it gets pretty easy. All right. So for everybody in here, this is where we start combining business tax law with real estate. This goes for those of you that have any sort of business income or any sort of LLC S corp, or if you have multiple properties. If you have multiple properties or multiple rental real estate, that's kind of like having your own business or business portfolio. So we're able to take business rules and put them into this. So the first one I always like to highlight is paying your kids. You can pay your kids out of your business or out of your rental property up to $13,000 a year. Your kids do not have to file a tax return or claim it as income, and you can write it off on your business or your rental property. So if I got 2 kids, I can pay $26,000 a year to my kids, write it off over here on my rental property or my business. They don't have to claim it or pay taxes on it. Then they can spend it on whatever they want. They can spend it on the nanny. They can spend it on groceries. They can spend it on Disney World. They can put it in a Roth IRA. It can go in a 529 plan. It could be a college fund, a car fund, whatever. They could own, this is what we just done with my little boy. They could own a condo, have rental real estate. I could pay my kid, which I do, $13,000 a year. That goes in to his LLC that owns rental real estate that helps fund the expenses for the condo he owns, that when he gets older is going to have all sorts of equity and cash flow and things. And so you can start combining these things and making a big difference. I had an agent here in town I work with. He wanted to build a swimming pool. I'll get to you in a second. He said, hey, I want to build a swimming pool. It's $90,000. How can I write it off? I was like, well, we can't write off a swimming pool, but here's what we can do. You have 3 kids. Let's pay them $36,000 in December. Let's turn around in January the next year and pay them another $36,000. We've now paid his kids $70-something thousand. We've written it off on his taxes, saved him $30,000 in taxes, and now the kids paid for the swimming pool. And so essentially in a roundabout way, we paid for the swimming pool. Question? Yes. They had to serve some sort of role. It can kind of be a made-up role. Everybody knows this is bullshit with the IRS. It's very generous. They have to serve a role in the business or do something or on the rental property. But you can do it with a toddler. You could hold them in an ad and it be advertising, or put them on social media and they could be a model. But you do have to actually move the money. The money has to go. It could be a custodial checking account they don't even know about. But you do have to move the money. Now, the other thing I love is something called the corporate retreat. If you're a business owner or you're a solo business owner or you're a 1099 agent or you own a few rental properties, that's a business. What the IRS gives big businesses, they have to give the small business or the solopreneur. So you get a corporate retreat once a year you can write off. That's getting out of the weeds and working on the business, not in the business. And so pretty much that means you get to write off a vacation. So you go take a trip somewhere, you go take your family somewhere, you go spend, it could be 4 days in Florida, it could be a week in the Caribbean, it could be going to California, domestic, international, it doesn't matter. You have a little agenda. I'm going to wake up and work on 2025 goals on Monday. On Tuesday, I'm going to work on my social media strategy for the year. On Wednesday, I'm going to find vendors and contractors. Have a little agenda. Now you get to write off all your flights, your hotel, your meals while you're there, your Ubers. You can easily write off a $3,000, $4,000, $5,000 vacation every single year through your real estate portfolio business or your business as an agent or contractor. You got a question. I love it.
You have one kid, you somehow figure about you giving them money. How earlier you said.
This just cost you 13 grand, brother. I know. If your dad ain't paying you 13 grand a year, we're changing that tonight.
If they figured out to know, like, it's my money now, I don't want to spend it on this thing, what should you do about that?
All right. So this is a great question. What you need is a written contract in place before you get this started, that when that money's paid, he gets to save on taxes, but you get to control the money and spend what you want to. So a very simple little contract will fix all your problems. And I hear you're in the business side. I hear you're doing yard work, you're running chainsaws, you're selling artwork. So you could probably get paid 20 grand because you got some write-offs all you have going on to get you down to the 13 and be in even better shape. So I like that. But you lose control there. So I love the corporate retreat because anybody can use that on whatever level makes sense to you. It may be $800 a year you want to spend. You may want to go to Helen for a couple of nights, or you may want to spend $8,000 and do something big. Very simple template, very simple format for it. You just do it and document it every year, and you're able to pretty much write off a vacation. Hold on, I'll tell you. One other thing I like to do with this also is I like to make the spouse part owner of the real estate LLC or the business, because now the spouse gets to write off travel. Now the spouse gets to write off vehicles and insurance. Now you can buy stuff for your spouse and you can write it off: a computer, a camera, a cell phone, AirPods. And so combine, and now keep in mind we're paying our kids. So now the kids are part of the business and work for the business. Now the whole family's meals on vacation get to be written off, the whole family's flights. And so you start taking these things and putting them together, and real quickly you're writing off 30, 40, 50, 60, 70, $80,000 a year every single year on your taxes, legitimately, all inside the tax code, all inside the loopholes, saving you at least $20,000 or $30,000 a year, not even counting cost segs, not even counting all the other things you can do we don't have time to talk about tonight. So I'll turn over to questions now, and we got, what, 10 or 15 minutes? We're good? All right, let's do it.
And you can take the whole family if they're all on your payroll. Can you do multiple trips that are not corporate retreat? Like if you go somewhere, if you go skiing, and you're looking at a
Yeah. So yes, that's a great question. So you've got buckets. Let's look. I like to look at it as buckets. You have like R&D buckets. I want to buy a property in 30A. So I'm going to go down there and look at property and try to find something to buy. That's a business trip. I can write that off. I want to go to a self-storage conference in Vegas. That's a continuing education or conference. That's its own bucket. You can write all that off. This is a separate corporate retreat bucket. So you can fill all those buckets up as many times as you want. So you could write off 5 trips a year if you can start combining all 3 of these. And so it's not kind of a one and done. It's each one kind of separately falls into different buckets.
but you pay them their money, that doesn't count as compensation.
Long as they stay under $13,000.
Right.
That's the key.
Trips,
No, that's right. That doesn't count. That's right. Yeah. You're just like taking your employees on a trip. Yep. That's it. You don't have to, that's not goes on their pay. Yep.
So that would be for an LLC that's just for a small business. So it doesn't have to be real estate necessarily. It can be like stuff on Amazon. There's
Yeah.
stuff
Absolutely. I own a tax office. I sell stuff on Amazon. I'm a landscaper. I own a furniture store. I own rental, whatever. Yep. There is great question. I typically say if you're profiting over 20 grand, it makes sense, which is pretty low because 15% of 20 grand is $3,000 in taxes. It costs you about $1,000 to set up an LLC S corp. And at my firm, it's going to cost you $1,000 a year to file that tax return. So year one, you got $2,000 of costs. Moving forward, you got $1,000 costs. If I can spend $1,000 and save $3,000, the numbers work. And so at 20 grand or more in profit, I'm like, the numbers make sense. And then it only gets bigger from there. And so you just start saving more and more money on top of it. Also, y'all will love this. Here's what even makes more sense. The S corporation is 83% less likely to be audited than anything else out there. Less than 1 in 10,000 get audited. When they do, 67% of the time, it results in zero change. So you got like 1 in every 25,000 S corps that get audited and owe any money back or have to change anything. And so the odds of getting audited with something like this is like way down. You can, but man, if they look at it, it just gets muddier. You're so much. I highly encourage having an LLC, even if you don't have the properties in there. Have an LLC with a checking account that's paying for the expenses or paying for this stuff or paying for your overhead. Like, it's so much easier to do some of these loopholes. There's so much less liability. And if the IRS comes knocking and they want to see something, I don't have to turn over my personal checking account and all my personal junk. And so you can, it's just not the best way for a couple $100 and $50 a year in a checking account, you can have it all done the right way.
You're talking about there's different kind of buckets you can fill, and just to get the most juice out of it, like where's the best place to
Honestly, right now, YouTube. Just Google like tax tips for real estate investors, tax tips for business owners. You're going to get way more creative advice, most of it legit, on YouTube and Instagram. And then what you need to do, hear it, listen to it, then go Google it, and let's go read some real stuff on it, which is, you'll get a lot of like CPA webinars. You'll get CPA forums. You'll get blogs that are legit, tax journals that'll either back up or squash kind of what you're hearing.
About your contractor company, construction company, did you build it from scratch? Did you purchase it from someone?
I'll just build it from scratch, yeah.
Did you know anything about any of that, or did you just?
Hell no.
That's what I'm saying.
Hell no. I interviewed a couple of contractors, didn't like the way they approached business. I built my own house after going to Starbucks, reading a book every night for 4 months on how to build a house. And then I'm like, well, I know how to do it now. I might as well start a construction company. And I started that. And I was like, I might as well get my GC license. And here we are 18 years later. Still live in that house. Damn thing ain't fell down yet. So you can. Great, great question. This is brand new in the grand scheme of taxes in the last couple of years. There's something called pass-through entity taxes. Your S Corp, your LLC S Corp, can now pay your Georgia taxes for you personally, and you get to write it off. So if you normally owe 10 grand in Georgia taxes, your business can pay your Georgia taxes, and now you can write that 10 grand off on your IRS taxes.
And you can direct where those state taxes go.
Or you can take that money, you're right, and go to Lydia's Place or Career Academy here or the police fund and direct where the money goes. Keep it here locally. It's different, but they can work together. But now you can pay, if you have an LLC S Corp, you can pay your business state taxes through the business and write it off on the IRS side. And so just by simply choosing where you pay something out of will save you $3 grand, 10 grand on your federal taxes, which is awesome.
Can we go back last year and convert an LLC to an S Corp to take advantage of that?
If you haven't filed yet and you have a federal ID number already. The only time we can go retroactively do that is if you already had the LLC set up and you had a federal ID number. You just didn't have the S Corp piece. So in some cases, yeah. Worst case right now, you can do it and take it back to January 1st, but you may be able to go back and do all of last year. For tax purposes, no. Having holding companies or layers of stuff rarely makes a difference in the grand scheme of yearly taxes. Now you start talking about estate planning or probate or some other stuff, and let's say $15 million or more, then that stuff starts to matter. But in most everyday world, S Corps owning another S Corp or layers or holding companies, they don't do much for us. It's more of a structure for estates or probate or kind of protection way more than tax planning.
So, little caveat on the business miles or writing off
Yeah.
this stuff. You got to make sure that you break out your business miles script. Don't lump
Yes.
in all your expenses into one. That's what a lot of people do.
So we can't write off the mileage.
You gotta have it. So
Mileage
yeah,
broken out on the second page of the Schedule C if you follow it that way.
I love it. Yep.
What app do you use? Any kind of app on the fly to keep up with your deductions as you go?
There's a ton of stuff out there. I use Google Drive. I use a Google spreadsheet. It's super simple. I have one tab that tracks when I'm going. Like I own rental property. We own 6 different rentals in Charleston in that area, Charleston and Kiowa. So every time I go to Charleston, I was just there this weekend, I get to write it off. I'm going working on my property. And so one tab of my Google spreadsheet is like when I go, what I work on. And so I just wrote off 4 days in Charleston, all my meals, everything I'd done there. It was awesome. And so I just kind of capture real quick, hey, I went these dates and this is what I done to my property. So if anybody ever asks, I can show I was working. And then my second tab is my expenses. I have, vehicle expenses. I have different, and so I throw stuff in just a Google. There's accounting programs, there's apps, there's 1,000 things, but honestly, a simple spreadsheet in Dropbox or in Google Drive is probably the easiest, fastest thing, and it costs no money.
Shannon wanted to be here, but she made sure that I'm. She wanted me to ask about, we inherited my
Yeah.
grandmother's property.
Yeah.
So now we got to sell it. How should we do that? We don't.
So great question. So the beauty, and man, I hated, God, your dad was awesome, man. God, talk about a fun guy and just a hell of a personality. I know it's tough, man. Inherited things become really easy because y'all get to receive it at fair market value. And so,
Okay, so prime example, 40 years ago almost, he bought it.
yeah.
And, bought it for like 138,000.
Yep. Yeah. So if he sold it, he had to pay taxes on 400 grand in gain. Well, you get it at 530. So now you sell it for anything in the next year or two, you pay no taxes. It's
better off though it would have been better off for me not to be on the title with it. It seems like from what I'm seeing is that it becomes tax free, like you were talking about.
yeah.
Because it's just an inherited.
That's right. If you were on the title with him, then you
Just in the last year, so we waited.
okay. I'd say you're fine. The intent was there of like it's inherited property. But worst case, if you wanted to be by the book and like half of it would get step up. So your half would be basis, his half would get stepped up to 260 or whatever it would be. And so you'd end up having like a $350,000 basis. But now honestly, this is where like there's like black and white tax law, and then there's kind of what you can do and kind of what they ignore and turn a blind eye to. I think in this scenario, you're fine taking full step up in basis. It's just not black and white tax law, which very few things are. And so yes, that's a good question though. You get basketball, you get all your meals served. You don't have to work at night, lift weights on the weekends. It's kind of what I'm working towards, I feel like. Sounds like retirement.
But is it true that you can't do any kind of cost saving on new construction, mobile homes?
No, we've done tons of cost segs on new construction. Trailers have their own depreciation, and so you get your own rules there, but you can still cost seg a trailer. It's still got air conditioned units and decks and light fixtures and carpet, and there's things you can still cost seg and speed up. Now, it might not make sense to if you're trying to cost seg a $30,000 trailer and the cost seg costs you $4,000, and it's like, I don't know if I don't get enough value, but you can still do it. But we do tons of new construction. New construction's actually the easiest thing to cost seg because I've already got the contractor numbers. I don't have to like use formulas for what the carpet's worth. I know the builder gave me the numbers of what the carpet cost. And so it's actually much easier and a much more accurate, more beneficial process with new construction.
How much do cost segs typically run when you have one
It's based on the size or what it is, but let's say it starts at $3,000 and goes up to 12, 15 grand. It's changed a lot. Things have gotten way. You can get computer generated cost segs. I've seen one somebody paid $750 for. You get what you pay for. I wouldn't have put it on my tax return, and I'm pretty aggressive, but you can. But now, cost segs used to, you couldn't find one for under 18, 20 grand. And so over the years, the formulas and the work has came way down. We now have audit guides for it. We know what to do. We know what formulas we can and can't use. And so it's way cheaper now than it used to be. All right, one more question. We got to wrap this thing up. Two more questions. All right.
Any benefits putting a property into a trust?
No. Not for tax purposes. Trust or something. Yeah, trust or something you spend if you're doing it to control it for my kids can't have this till I'm 30 or until they're 30 or until they graduate high school or if you're over $20 million, trust makes sense. Outside of that, trusts are kind of a waste of money for tax purposes right now. But now for probate and for other stuff, like I have a living trust. That's different. That's so all my crap don't get hung up with the courts and the government. It can just go to my wife or my kid without a whole lot of hassle.
Correct me if I'm wrong, but you run into different kind of tax ramifications for development projects versus just acquisition, correct?
You do. Development is a whole different deal. So they have these rules called placed in service. You can't write things off or start depreciating until something's placed in service. That means when it's listed or advertised for rent or somebody moves into it or it's finished and you have a CO. And so a lot of people think, oh, I bought $500,000 worth of land. I'm going to develop. I get to write that off. No. Or you go do a bunch of site work and say, I done 300 grand of site work this year, getting ready. I can write that off. No. Site work you can write off and accelerate once it's placed into service, but you can't place it into service until it's finished or it's rentable or marketable for rent. And so a lot of people spend a lot of money thinking they can write it off in development, and you can eventually, but it takes a long time to get there. And if you are a developer, you're in the business of developing, now you have even different tax rules. That's your business. You're not an investor. So that kind of changes things a little bit too. It depends. Sometimes you have to capitalize it and wait. Sometimes you can take it in real time because you do enough of it. So it gets tricky. Yeah. So you do have you're right, a different lens. All right. Thank y'all for having me. I hope this was valuable. I hope this helped you. I appreciate it.
Awesome. Thanks for coming out. I know there's a lot of first-time people here, so make sure that you either like the Facebook group or make sure I get your contact info so I can get you on the email list for later. Thank you very much. You can share it with me. Hey, thanks very much for coming.